Well, hi, everyone, and welcome to the Buffett and Beyond Research Saturday Market Recap Letter. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week, well, the market is ending the week on a good note, but all in all, it is down 2 weeks in a row. Can you believe it? And the market is adjusting to the possibility we just might not see a rate cut this year, but that's all Fed talk right now. But Jay Powell is still positive on rate cuts for this year, and Jay Powell is head of the Federal Reserve, so we might want to listen to him rather than all the other rhetoric that's coming out by the Fed members who keep getting asked that question about rate cuts. Now, the jobs report came in very strong today, and that has the market worried in one way, but in another way, it has the market very, very happy because the economy's doing great, folks. That's why we might not even have a recession. So that's the good part on the market. And the salaries did not go up very much at all. And that means that the salary increases are not inflationary. In other words, the economy's creating more jobs, about 100,000 more than they expected, but the wages didn't increase in an inflationary way. That's why the market ended the week on a very, very good note. Now, our weekly stock analysis, well, we're going over to Broadcom, and that company used to be called Avago, and it is growing by acquisition, and for them, this strategy is working to perfection. It's up more than 500% relative to the S&P over the past 5 years, and I mean more than 500%. And our ETF video, well, the top stocks in our top ETFs are doubling the S&P after only 3 months into this new year. And our best performing top stocks are up 20% the past 3 months alone. So, folks, the strategy of the clean surplus methodology in selecting the best stocks in any index, or I should say the above average stocks in any index, and leaving the below average stocks for somebody else to buy is working perfectly. And folks, don't forget, we have a 22-year track record, and nobody else has that long of a track record to show how good their strategies work. And let us look at the market this week, and here we are. Top band and the bottom band, or I should say the red lines, are called Bollinger Bands, and they are, well, if you really want to know, see that center line there, 20-day moving average. The red lines are 2 standard deviations. I know, remember that statistics class? 2 standard deviations above and below that center line, and the market stays in there 95% of the time. So here we are just playing around this 20-day moving average. On Thursday, fell below it. Friday, closed above it. So what are we supposed to do? Well, we got to be a little careful in here because this indicator down here is our intermediate term indicator, and it is falling down. So we'll see what happens as we go along, but we're being a little cautious in here, or I should say the market is being cautious in here. Our stocks, as I said, are up 20% on our best portfolios in those ETFs, where we picked the best ETFs in the QQQs, and our all-stars, or sector stars I should call them, are doing very, very well. And let us look at the S&P 500, and again, this green line is the 20-day moving average, and you can see where we fell below it, scared everybody, and then closed above it. This is the 50-day moving average, and it comes in a later slide in just a second. And again, down here, here's our intermediate term indicator, and it is turned down, not in a big way, but enough to just be cautious in here. Now, let's look at the Dow Industrials, and we can see that overall, over the past 2 months, the Dow Industrials really have not moved very much at all. Not very much. They haven't moved at all. So here we are down here. Now, the Industrials have fallen below this blue line, which is the 50-day moving average, and Friday just closed above it. Just a tad, and I might even say right on it. So we're watching that 50-day moving average on the industrials, and we'll see what happens next week. Down here, we can see that this indicator has been sloping down, and yet the market is standing still. And if you want to go back further from here, yeah, it's up a little bit from here, but we could see this downward sloping. But this line down here is called our neutral line. And when this indicator falls below that neutral line, it kind of gives us a hint that this selling, or I should say indecision more than selling, is drawing toward a close. Look back here when it got into the oversold position, in other words, below this line, when it got into oversold condition, boy, we had a rally that kind of knocked our socks off. This was beautiful in here. So that's what we're looking for. And the point that I'm trying to make here is that this indicator is going down without us seeing damage on the index itself. And the stocks that we picked from this index are doing very, very well and continue to grow. The key is to put good stocks in your portfolio, folks, and you keep them there until they're not good stocks anymore or until they're replaced by a better stock. Now let's go to our favorite, the QQQs, and we could see past month or so, actually past 2 months, the QQQs have not done anything except go up and down. And here we are sitting on that, or we touched that 50-day moving average, bounced up above it, but the QQQs are sitting right between the 20-day moving average and the 50-day moving average. And folks, we're getting our best returns. We're up 20% in the QQQs. Well, the QQQs are up only 7%. Our top stocks are up 3 times the average, or the QQQ average. Folks, that's phenomenal. We got a 20% return going here, and it's only the first 3 months of the year. And you can see down here the same kind of scenario. It has been, I don't want to say selling off, it's been getting weaker and weaker and weaker without the index itself selling off. Now, the index hasn't moved very far this year, but the top stocks up 20%. And folks, you want to be in that ETF letter to see what those stocks are. You buy them, you forget about them until we alert you that there's a change in them, folks. So let's keep going with these stocks, 20% return. And folks, remember, if you want a money manager to handle some of your money and be in these best stocks, give us a note. Just email us and we'll tell you a money manager in your area. Because we don't manage money. We just tell you what the market is going to do. We're research people. There's other people that handle your portfolio for you. Okay, what's coming up this week? Well, Monday, you don't want to wish the solar eclipse. And guess what, folks? The sun has to be out in order for us to have a solar eclipse. So it'll happen during the day. So that's our exciting move on Monday. And then really Wednesday, the CPI report comes out and we'll see what the inflationary report is going to tell us. Now, Thursday is Constellation Brands, and a lot of you have Constellation in your portfolio. We don't, but during the week, in our weekly letter, we come out and we'll talk about Constellation Brands, and we'll show you all those statistics on Constellation Brands. Should it be in your portfolio, or shouldn't it be in your portfolio? And folks, there's somebody on TV that has this in their portfolio, and we are kicking butt on their portfolios over the past 5 years, folks. Yeah. It's not what you say and how much you yell at people and how much you jump up and down. It's the performance that counts, and ours certainly beats his. Okay, and on Friday, here we go with the banks. We just ended earnings season, and here we are starting with the banks all over again. So here we go. We'll take a look at BlackRock during the week, during our weekly letter. Also, we'll show you the statistics there and see how BlackRock is doing, because they've been in the news lately. And not all the news has been good, because they're all over the place. Let's see how they perform, and we'll check that out during the week. So, folks, there you have it for next week. Here we go with the beginning of earnings season once again, and you got to be careful, because boy, oh boy, if these stocks don't meet expectations, they fall like a rock, and then it takes them months to come back, but they do. If they're a good company, they're going to come back. Now, as far as portfolio protection goes, for those of you who want the disaster insurance that we talk about at 12% more or less below the market so that you could sleep at night, and it's not very, very expensive at all, we have April puts, and this is for about a $140,000 portfolio. We have one April SPY put, one May SPY put, and one June SPY put, and you can see we have them spread out, so we roll over once a month for one of the put options so that we're always protected. And you can see in here that as the market moved up, so did we move up our insurance protection on these put options on the SPYs. Now, the SPY represents or follows the S&P 500. So it's a smaller than the SPX. In fact, the SPX is a put that is 10 times larger than the SPY. So for you folks that have large portfolios that you want to protect some or all of it, you might be looking at the SPXs and about the same price points, and they follow. So just keep up. We send out alerts on this, and folks, you want to be there with portfolio protection for those of you who want portfolio protection. Some do, some don't. Some want to be protected better, which we go over in our daily letter. So, folks, guess what? We had a tumultuous week this past week. The market was up, the market was down, just like this ocean right here. But the sun is coming out. This is the sun rising over the Atlantic Ocean. So, folks, you go out, you have a good weekend, take it easy, because guess what? The market will be here on Monday. So, folks, you stay safe, be with your family, be with your loved ones. We'll see you next week.